Hi, I'm Assistant Professor Aditi Mathur, International Schools of Business Management, Suresh Ganvia University, Jaipur. And in today's video lecture, we'll be continuing about our discussion on ratio analysis. So let's just have a quick recap of what we have covered in our previous video lecture. So we have learned about what is ratio analysis, what do we mean by ratio analysis, then we even understood the process, the four-step process, then advantages which are associated. So just a quick recap that it helps in forecasting and planning, budgeting, measurement of operation efficiency, your communication, control of performance and cost, interfirm comparison, indication of liquidity position, indication of long-term solvency position, indication of overall profitability, signal of corporate sickness, aid to decision making, simplification of financial statements, etc. And we also discussed about the limitations. So limitation is the limitation of financial statements, historical information, the accounting policies, lack of standard of comparison, quantitative analysis, window dressing, change in the price level. Then the relationship must be there. Then ratio account for one variable, seasonal factor affecting financial data. These were all the limitations which we had covered. And we also just had a quick preview on the asset side of the balance sheet, then on the liability side as well. So today let us just start with our discussion on the income statement. So in our one of the income statements which we use for the computations of the different ratio is this one, that is sales amount, total sales. We take the total sales amount, we deduct all the cost except interest and taxes. All the costs, your fixed, your variable, just don't deduct your interest and tax. Rest all of the cost. Your depreciation will also be deducted. Your raw material purchased, your carriage cost, your production cost, your advertisement cost, your promotion cost, your packaging, your office and administration. All the costs get deducted from the sales amount. Then the amount which is left after the deduction of the sales and all the costs except interest and tax, you come up to the EBIT, that is earning before interest and taxes. Right. So the EBIT is generally a good parameter which we take into the consideration for the computation of different ratios. It helps us out for computation of different ratios. So this EBIT, then further we deduct from this EBIT the interest, right? Interest which you have paid on the bank loan or to the debenture holders, right? So that interest get deducted, and then you get, or you will end up to EBT, that is earning before tax. Now you have come up to that point where you have to just pay the tax. All the other expenses are paid, right? You have gained or added all the incomes, and then later on you deduct your tax which is there as per the law, and then you get your EAT, that is earning after tax, right? So now you are at that point that you have paid all the legal obligations, all the major cost, right? So the earnings which are available after the tax helps you out for further computation. From this EAT, you first give the dividend to your preference shareholders, right? Because preference shareholders have this right, and they have this preference to get the first dividend, in comparison to the ordinary shareholders. So they will be first given or distributed the dividend. Later on, the amount which is left after the payment of the dividend to the preference shareholder is known as EAES, that is earning available for equity shareholders. From this EAES, that is earning available from equity shareholder, you distribute the amount which you want to give to the shareholders, the ordinary shareholders, as dividend. So you distribute the ordinary dividend, and then the remaining amount is your retained earnings. So this is one of the a very good format in which we compute even the amount to be distributed, the amount which is left as a retained earning. You take care of the tax also and other interest charges also. So please remember this hierarchy, this computation table, because it will help you out in the calculations which we are going to do today. So today we are going to do lots and lots of calculation, and we will start discussing the different ratios, and we will solve those ratios as well. Right. So I do hope now you know what all are there in the asset, what all are there in the liabilities, and then the income picture is also clear. Now let us just have a understanding that what are the different categories of ratios. So entire ratio analysis are categorized in 5 heads. The first one is your liquidity ratio set, then you have leverage ratio, then you have your coverage, turnover, and at last you have profitability ratio. It is not always that in the same order, but these are the 5 basic categories which we must know in detail, and you should learn about these 5 in detail at this level of your program, right? So let us just first start with the discussion on the liquidity ratio. So today we are going to learn about the liquidity ratio. What is liquidity ratio? What are the ratios calculated under the head of liquidity ratios, right? So liquidity ratio tells one's ability. Who is this one's over here? The firms. Tells firm's ability to pay off its debt as and when they become due, right? So liquidity ratio is that ratio set which helps you out to determine the paying capacity of your debt. In another word, we can also say that this ratio tells how quickly a company can convert its current assets into cash, right? So if you have your current assets with me, we know the list of current assets, we have discussed it, those assets which are there for the less than 1 year, and they includes your cash, marketable securities, stock, bills receivable, debtors, and other current assets. So they all, right, converted into cash. How quickly you can convert your debtors into the cash, right? How quickly you can convert your marketable securities into cash? How quickly you can convert your short term investments and savings into the cash? That is also understood in the liquidity ratio. Why we want to convert them into the cash? So that you can pay off its liability on timely, right? So you have the liabilities with you, the current liabilities. So how quickly you can convert those assets so that you can pay off the liabilities. Let's take an example that all of a sudden you come to know that tomorrow you have to pay to your creditor, right? So creditor's amount will get due tomorrow. So how quickly you can arrange that fund to pay out that amount to which you have to pay to the creditor will help you out in the calculation of the liquidity ratio. How quickly you can convert your asset. Maybe you might sell your short-term, investments, or the savings accounts will be, money will be withdrawn from them so that you can pay your creditors. So this, paying off the conversion is a part of your liquidity ratio. Generally, liquidity and short-term solvencies are used together. So now why liquidity ratio? One of the very good questions is why liquidity ratio? So liquidity ratio affects creditability of company as well as its credit rating of a company. So we all know that we all have credit rating system, right? So what is credit rating? One and the foremost thing we have studied it in our financial system lecture, that with one of the services is the credit rating. And credit rating is to check the capability of an organization. They rate the organization that how well that company manages its credit. If they have taken loan, have they paid it on time? Do they have that sufficient money to pay the money, or repay the money and the interest? Were they paying properly or not? Right? How many times they have taken the loans? How many times they might be the defaulters? And on the different criterias, right? There are many criterias. There is entire a chart, there is entire syllabus of the credit rating. They decide your rates, and these ratings are alphabetically, that different agencies follows different credit ratings. So few use alphabeticals like A plus, A B, then we have triple rating, AAA, AABB, and these all are used in the credit rating of the company. So that what happens if that all of a sudden you come to know that this company is AAA rated in your credit rating, that means that the company, if taking any loans or if taking any of the amount from the market, they pay off very well, they have a good credit rating, they are worth it, right? So this is one of the ratios which are used in the credit rating of the company. If there are continuous faults, right, in repayment of short term liabilities, then this will lead to bankruptcy, right? So if you're not paying your amount on the daily basis, if you are not paying your interest, or you are becoming a defaulter, right, you are not paying on time, that then there are the probabilities, a good amount of chances that you might end up as a bankrupt, because you are giving that signals, you are giving those signs that we are not able to pay back at time, or we are not managing our funds properly, right? So this is one of the ratios which helps you out to check that where are you going bankrupt or not, right? This is how you check the company's creditability, this is how you check the financial position, right? Then this ratio plays a very important role in financial stability of any company and credit rating. So the two main ratios which we will study under the category of liquidity ratio is your current ratio and asset test ratio. The asset test ratio is also known as quick ratio, right? So the two main ratios which you are going to study as per your syllabi is current ratio and asset test ratio or quick ratio. Now let's first discuss what is current ratio, right? So the current ratio is a ratio which helps you out to measure financial strength of the organization. Generally, 2 is to 1. That means 2 is to 1. This part is the treated as the ideal ratio. But it depends on industry to industry as well. So we had actually discussed this in our previous lecture, that how the industry to industry varies in the idle ratio, and this is one of the drawbacks which we had discussed, that we cannot set the standards. And why we cannot set, we had already discussed this. So the formula to calculate your current ratios, that is CR, you can use the abbreviations as well. So CR can be calculated by the formula, that is current assets CA divided by current liabilities, that is your CL, right? So now again, you need the help of your balance sheets, because over here you should know what all fall under the category of current asset, what all fall under the category of current liability. So if we discuss the step number one, to check the balance sheet and identify all the current assets and all the current liabilities. Step two, add the all total current assets, total current liabilities. Step three, divide them as per the formula, and then you will get your ratio. And then step four is to give a concluding statement, right? So the ratios formula is current asset divided by current liability. So let us just have a quick recap on what all are there in your current assets. So this is your current assets side. So you have cash in hand, cash at bank, debtors, stock, bills receivable, short term investments, short term loans and advances, prepaid expenses, income earned but not received, and your other current assets. And if you talk about the current liabilities, you have bank overdraft, creditors, bills payable, short term debts, your advances and deposit received, outstanding expenses, and other current liabilities. liabilities. So first and the foremost thing, you should know which particular item falls in which category. That means, it a part of your current or non-current, or it is a part of your asset and or liability. So you should be very clear with this thing, right? And then only you will be able to calculate further, because if you have not added any of the particular item, your total will not come which it should be, and your ratio will be wrongly calculated. So please by heart all the items which are there in your balance sheet, and where in which category do they fall, because it is very very important in the computations of the ratios. Then once you divide the current assets and current liabilities, you find the ratio. We will do a question, and we will even compare it with the idle ratio, and we will pass the statement. But right now, just a basic introduction, that what is current ratio. So current ratios helps you out to measure what? Measure your financial strength of the company. Now, let's have a discussion on the second ratio of this category, which is asset test ratio. This asset test ratio is also known as your quick ratio. Right? So quick ratio or asset test ratio is the best measure of the liquidity in the company. Right, this is one of the very best measures you can use. Even it beats up the current ratio. So if you have the asset test ratio, it is more refined version. This ratio is more conservative compared to the current ratio. The quick assets is computed by adjusting current assets to eliminate those assets which are not in cash. So you see over here, I have a list of the current assets, right? So we have the stocks, debtors, cash in bank, then your receivables, loans and advances, your other current assets, all of them are here. Few of them are not in the form of cash, and it takes time to convert them into cash. They cannot be converted very easily into the cash, right? So this quick ratio helps you out to eliminate all those such current assets, and left amount is that amount which is very quickly into the cash, or is equivalent to cash also. Right? So what do? They have their own formula, that is quick ratio is equals to your quick assets divided by current liabilities. So we are not changing the denominators. If you are comparing it with the current ratio, it is current asset divided by current liability. So you are not changing the denominator. Denominator is same, that is current liability and current liability. The only difference is in your numerator, that is your assets, right? So in current ratio, you take care of all the current assets, whereas in your quick assets, you just take care of those which are easily converted into cash or equivalent to cash. So you ignore or eliminate those assets which are not in cash form, right? So formula for your quick asset is current assets minus prepaid expenses, or prepaid expenses, and your inventory. Now see, inventory or stock, one and the same thing, right? So it is difficult for you to sell your stock, right? And if you are able to sell your stock, right, that means it will become the sales value. The assets, if you talk about the asset, it is a bit difficult to sell the stock right now at that very moment, on the time when the creditors are standing outside your door of the warehouse, and they are saying that we want the money, it is too late, just pay it up. So you will not go and take the bags of your raw material or your finished goods and go into the market and sell it. No, it is not that easy. It is not in cash, and it takes times to convert into cash. So that's why you will subtract that amount of these stocks. Then prepaid expenses. Prepaid expenses are those expenses which you have paid, but the services will be now, taken into the consideration. You will receive the services just like the prepaid connections you have in your mobile phones, right? Or for the internet connectivity. So those expenses cannot be even converted into cash. Now you cannot go back to the Airtel office and say that I am using the prepaid one, so now can you just give me the cash? I want to, discontinue my function. They will not do it. They will not be able to pay you back the cash amount. So it's the same way, we cannot convert the prepaid expenses into cash again. So that's why in current assets, right? Again, remember what I'm saying current assets, you have both cash items and non-cash items, but in quick assets you include those which are cash or equivalent to cash or very easily quickly converted into cash. So that's why you subtract inventories and prepaid expenses from your current assets, and you say that type of asset as your quick assets, right? So now you know what is quick asset, you know what is current liability. You will divide them up and you will come up with your quick ratios. And this quick ratio, the ideal ratio, is generally 1 is to 1. Again, it depends on the industry to industry, but if you have 1 is to 1, it is good. You are doing good. Your organization is, well managing all your assets, liabilities, incomes, and expenses. So it is good if you have 1 is to 1. Ideal ratio is 1 is to 1. So you should know ideal ratio, you should know the meaning why you are computing, you should know the formulas, you should know the items which fall under the which category, so that you can compute your entire ratio. Right? So now let us just do a question. So I have an illustration with me. Let's solve it one by one and we will do it together. So just everyone take out your calculators, paper and pen, and let's solve this question together. So the question says that calculate current ratio from the following information. Okay. So see, read the question properly. They are just asking you current ratio. If it would have been written liquidity ratios, then you have to calculate both current and quick. But it's just current ratio, so we will simply calculate the current ratio. The particulars are given to you. In particulars, you have inventory, trade receivables, advance tax, cash and cash equivalents, trade payables, and short term borrowings or bank overdraft. And the respective amounts of the accounts are also given to you. So, the first step, the first thing which you should do is to categorize each item into your current asset and current liabilities, right? So these all inventories, trade receivable, advance tax, cash and cash equivalents are a part of what? Are a part of your current assets, right? And the other remaining part, that is this trade payables and short-term borrowings, are your current liabilities, right? So the bifurcation plays a very important role. So now you know you have to calculate current ratio, you have current assets and current liability. Just add them, divide them, and your ratio is in front of you. So, but we will do it step by step. First and the foremost thing, categorize them, then write the formula. So the formula for the current ratio is current assets divided by current liabilities. Then calculate the current assets. So in current assets, you will add the values of inventory, trade receivables, advance tax, cash and cash equivalents. So 50,000 plus 50,000 plus 4,000 plus 30,000. You will add them, it will come up to 1,34,000. Take a time, check it. Is it coming to 1,34,000 or not? It will, right? So calculate it by yourself and check it out. Then you will calculate the value of current liabilities. So in current liabilities, you have only two current liabilities, that is 1 lakh and 4 lakh, which is trade receivables and your short-term borrowings respectively. So you will add them up and you will get the value of your current liabilities, right? So now you know the formula, you know what is your total current assets value, you know the current value, current liabilities value, divide them up. And when you will divide, you will get the ratio to be 1.29 is to 1. What was the ideal ratio? Ideal ratio was 2 is to 1. But what you are receiving? You are receiving less than ideal ratio. That means 1.29 is to 1. Now, what does this ratio is indirectly telling you up? They are telling you have 1.29 rupees to pay 1 rupee liability, right? Again, what they are in, I'm just trying to convert it into easy way to tell you how you calculate and what is the understanding. They are saying you have 1.29 rupees assets, current assets, to pay the 1 rupee current liability, right? So this is the ratio what they are trying to say. So it is okay, but don't you think if you will pay it, you will be just left with 0.29 paisas in your account if you pay the 1 rupee expense also, right? So that is why only having 0.29 will not suffice, and that is why we say it should be 2 is to 1, right? The ideal ratio is 2 is to 1, that if even you pay the 1 rupee, you are left with the entire 1 rupee which will be used by you to pay uncertain or contingent expenses also, right? There are many expenses which a business has to take. There might be probability that you have to tap onto a opportunity and you need the funds, so you should have some amount of money, and that is why the ideal ratios is considered to be 2 is to 1. But this company is having the ratio of 1, right? 1.29 is to 1, right? So that is why we are saying that this company needs to improve its performance, right? Now, let's solve another question, that is the calculate quick ratio from the information given in our previous illustration itself. So this was the previous illustration which we were having, right? So we were given the current assets and current liabilities. We had already was diversified into two parts. Now let us just calculate the quick ratio. The first and the foremost thing is your formula, which is quick asset divided by your current liabilities, right? So now first calculate your quick assets, because you already know your current liabilities, which is 1,04,000. So you know the value of current liability. You need to know the value of quick assets. So what was the formula of the quick asset? It is current assets divided by minus inventory, sorry, and minus your prepaid expense, if any. So let us just check. Your current asset was coming up to be 1,34,000. You will subtract the stock or the inventory, that is 50,000. Do we have any prepaid expenses over here? Just check. No, we don't have any. Yes, we have prepaid expense, that is advanced tax. Advanced tax is your prepaid expense. So you will subtract the prepaid expense also, and the amount which will come will be your current quick assets, son. So your quick assets is equals to 80,000, right? So now you have your quick assets, you have your current liabilities, you will divide them and you will come up with your quick ratio. That means it is 0.77 is to 1. Now what does this signifies? That if you have to pay 1 rupee liability, at present the quickest cash equivalent you have is only 0.77 paisa. You don't have even 1 rupee, right? So you might have to borrow the money from market, or you have to sell your fixed asset so that you can pay your liability, right? So that is why it is not in a good position. The company is not doing financially well, right? It is not in that strong position because the ideal ratio was 1 is to 1, right? I do hope now you have understood how we are, comparing and dealing with the ratios and interpreting the ratio and the financial statements, right? So this is all about your liquid ratios. So we are done with the liquid ratio. We have covered the quick and current ratio. So we have completed the liquid ratio, right? Now let us understand the leverage ratios. So, leverage ratios are the financial ratios used to measure a company's financial structure, right? Financial obligations and its ability to clear those, obligations. So, leverage ratio deals with your capital structure. So now we know what is capital structure, right? Capital structure is that combination or a structure of different debt and equities and the combinations from which you have borrowed the funds and your company is running on, right? So this combination related calculations or the ratio computations are under the category of leverage ratio. The financial aptitude of the company is measured by the investors, board of directors, creditors, and others by using these ratios. A leverage ratio is a financial ratio which can be defined as the financial metrics to measure the capability of the company to pay off its dues for how much assets is put to use with the loan taken, along with being a good indicator of capital structure. There are different ratios which are categorized as leverage ratios. So we'll look them into the next slide, that what are the different ratios which are there. So first and the foremost thing is that your leverage ratio is that ratio which helps you to define the financial metrics and the capacity of the company to pay off its dues, in comparison to how much assets you have and how much loans you have to pay. So the first ratio under this category of leverage is your debt to EBITDA. थोड़ा बड़ा वर्ड है, but don't worry about it. You know it and you will learn it very easily. EBITDA. So debt to EBITDA. You know the beauty and the one of the advantage of the leverage ratio is that the ratio's name itself gives you the formula. How the entire ratio debt to EBITDA is giving you the formula by itself and saying that you don't have to do anything. Just divide the total debts with EBITDA. So you don't have to by heart the formula because the name of the ratio itself is telling you the formula. So it is a very good thing, and you should all the students really love the leverage ratio. They don't have to learn additional formulas, right? So now the tension and the headache comes that what all are considered in debt and what all are considered in EBITDA, right? So this is one of the things we should actually take into the consideration, that what falls under the category of your numerators and what are added in your denominators. So first and the foremost thing, first understand what is this ratio all about, why you are calculating it. So this ratio is to used to measure the capacity of the company to pay off its debt. See, we are talking about the debt, पूरा का पूरी उधारी. डेट मीन्स उधारी ना एक तरीके से. तो कितनी कैपेसिटी है आपकी ये उधारी पे करने में, दिस इज व्हाट दिस रेशियो इज समवेयर डाउन द लाइन टेलिंग यू ऑफ. It mainly used by the credit rating agencies to calculate the financial picture of your organization. Financial institutions भी use करते हैं, and to check the availability of the amount you have to pay the debt and how efficiently you can pay it. So now, first and the foremost thing, let me tell you the full form of EBITDA, that is earning before interest, tax, depreciation and amortization. यहाँ तक तो पढ़ा था हमने, EBIT तक, है ना. अर्निंग बिफोर इंटरेस्ट एंड टैक्स तक तो अभी हमने पीछे इनकम स्टेटमेंट में देखा. वी नो व्हाट इज EBITD, EBIT, राइट. बट अब आगे DA और लग गया है, तो D stands for depreciation and A stands for amortization. यानी कि सेल्स वैल्यू में से आप सारे एक्सपेंसेस माइनस करेंगे एक्सेप्ट योर इंटरेस्ट, टैक्स, depreciation and amortization expenses. इनको छोड़ के आप सारे एक्सपेंस माइनस कर दीजिए, जो अमाउंट आएगा वो आपका EBITDA मिल जाएगा आपको. right? So why we are using EBITDA? First and the foremost thing, we are taking EBITDA because it is that amount which is earned um, just by your sales, and after deducting expenses related to your production, office sales, and etc., right? Your tax is advanced step, your interest is an advanced financial step, right? Your depreciation is a non-cash expense, that's why amortization is a different concept. So that's why you are not taking these amount into the consideration, you're just deducting those expenses which are a part of your production or a part of the main company's orientation, right? So that is why you deduct the expenses on except your interest, tax, depreciation, and amortization, and you come up with your EBITDA. The second ratio which you do over here is your debt to capital, right? So again, formula is very simple: debt divided by capital. Now capital is actually your summation of your total debt and total equity, right? So your total debt is divided by your total debt plus total equity. So it is used to compare the debt and the capital. It is a ratio which helps you to use the analyze the financial structure of the company and check how business operates and getting financed, right? Then comes your debt to equity. Again, total debt divided by total equity. The formulas are very easy. The name of the ratio itself tell you about the entire formula, right? So this ratio is used to compare the different, to compare between the equity share holding or investment to your liability, that the amount of your debt and equity is check कि कितना पैसा आपके ओनर्स का है और कितना उधारी का है. That ratio is taken into the consideration by debt is to equity. Then come debt to asset. Total debt divided by your total assets, right? So this ratio is a relation between the total debt to the capital company to assets, and understand how much debt is used in financing the assets of the company. यानी उधारी का पैसा जो आपने लिया था, वो पैसा कितना assets को create करने में लगा है. This ratio helps you out to check that. Now let's just do a question, and with the help of this question, you will easily understand how to calculate and what all are part of your debt and equity, and what how to interpret these ratios of leverages, right? So let us just assume ABC company has your 10 lakh capital, and the capital have a ratio of 40 debt and 60 equity. The company earning before interest and tax is 1 lakh, right? So EBIT is 1 lakh. It has accounted for the depreciation and amortization in its financial statement in the current year to be 15,000. So depreciation value is 15,000. The asset of the companies are 7,50,000. Calculate different leverage ratios. That means all the leverage ratios which you can easily calculate from the information given to you, you have to calculate all of them, right? So first and the foremost thing is to calculate your debt to EBITDA, right? तो पहले आप लिख लो, पहला आपको क्या कैलकुलेट करना है, डेट टू EBITDA. ए डेट का वैल्यू मालूम है, हाँ. कैसे? मैम टोटल कैपिटल इज गिवन टू अस, एंड वी हैव बीन टोल्ड दैट 40% ऑफ देम इज योर डेट. सो 10 lakh का 40% इज हाउ मच? मैम इट इज 4 lakh. सो वी नो दैट द डेट इज गोइंग टू बी आर 4 lakh. चलो, that's good that you know the one of the part of the formula, that is that. अब EBITDA पे आ जाते हैं, राइट? तो EBITDA के अंदर आपको ये दे रखा है कि EBIT कितना था, कितना दे रखा है, इट इज गिवन टू बी 1 lakh. They have given it that depreciation is 15,000, right? So now you have to come up with the answers of EBITDA. अब आपको है ना amortization का कुछ नहीं दे रखा, मान लो जीरो, हो सकता है amortization expenses ना हो, तो it is zero. So now what we will do beta, we will add these two values, that is 1,15,000 will be your EBITDA, राइट? अब कुछ नहीं करना, आप अपने 4 लाख को 1,15,000 से डिवाइड कर लीजिए, यू विल गेट योर debt to EBITDA, which is your 3.48 is to 1. Right? Just take a minute what we have done. Just read till this point. क्या किया? टोटल डेट डिवाइडेड बाय EBITDA. टोटल डेट 4 लाख था, हमने कैलकुलेट किया 10 लाख का 40%, एंड देन हमने 1 लाख के अंदर 15,000 जोड़ दिया, तो हमें क्या मिला? हमें मिला अर्निंग बिफोर इंटरेस्ट टैक्स एंड इंटरेस्ट टैक्स डेप्रिसिएशन एंड एमोर्टाइजेशन. Amortization expenses were not given, that's why we taken the amount to be zero. So you can write plus zero also, but there's no sense, so your amount is 1,15,000. And when you divide it, you get it to be 3.48 is to 1. Clear till this point? Can we move ahead? चलो आगे बढ़ते हैं, दूसरा रेशियो कैलकुलेट करते हैं लीवरेजेस के अंदर, क्योंकि सारे करने हैं ना. तो अब दूसरा क्या है? डेट टू कैपिटल. बहुत आसान है. डेट अपन ने निकाला था ना 4 लाख, हाँ जी 4 लाख निकाला था. अब क्या करना है मैम? टोटल कैपिटल से डिवाइड कर लो. मैम वो 10 लाख है. गुड. Then divided with your 10 lakh, and the value which is, it is 0.4 is to 1. This is your debt to capital. Right? Now comes your debt to equity. कुछ नहीं करना, डेट का आपको वैल्यू पता है, इक्विटी का वैल्यू पता है. अब इक्विटी आप दो तरीकों से निकाल सकते हो. या तो आप 60% ऑफ 10 लाख निकाल लीजिए, और या तो 10 लाख में से 4 लाख को माइनस कर दीजिए, जो कि आपका डेट वैल्यू है. इट विल गिव यू द इक्विटी वैल्यू विच इज योर 6 लाख. So what you have done, you have divided 4 lakh with 6 lakh, which is 0.67 is to 1, right? Then come debt to asset. So what you do, total debt to total asset. Assets value were given to you in the question. Debt you have calculated, and you will come up with the answer of 0.53 is to 1. Now the question come is the analysis part. Now we have to analyze these ratios, right? So now let us just analyze them one by one. What is debt to EBITDA is saying that if you have earning before interest, tax and depreciation and amortization expenses to be 1, this 1 rupee is because of, is generated because of the 3.48 rupees of debt. What is this debt to capital is saying? That in 1 rupee capital, 0.40 पैसा is of your debt. उधारी का है, राइट? 1 रुपया जो आपके पास है, उसमें से 0.40 पैसा उधारी का है, डेट का है. Then what is debt to equity is saying कि कंपनी के अंदर 0.67 आपका डेट है, तो 1 आपका इक्विटी है. This is your debt to equity. Then debt to asset, 1 रुपए के असेट के अंदर 0.53 रुपीज आपने जो उधारी ली थी ना, उसका है, right? So 1 rupee asset comprised of your 0.53 paisas of that debt amount which you have. And this is how we analyze the financial statements. That कितने में कितना है, 1 रुपए के असेट में इतना उधारी का है, 1 रुपए की टोटल कैपिटल में इतना उधारी का है, या कितना आपका कमाई का है. दिस इज व्हाट इज अ पार्ट ऑफ योर leverage ratios, right? So before we wind up, let us just have a quick recap on what we have learned today. So today we first and the foremost seen the revised statement, a table of income, in which we have learned about EBIT, EBT, EAT, EAEAS, and then your retained earning. Then we discuss the liquidity ratio and your leverage ratio today. In the next video lecture, we will cover the coverage ratio, turnover ratio, and profitability. So this video lecture comprises of your liquidity and a leverage. In liquidity, you have covered your current ratio and asset test ratio. Current ratios formula is current asset divided by current liability. Ideal is 2 is to 1. In asset test ratio or quick ratio, the formula is quick assets divided by current liability. Now the quick assets formula is current assets minus inventory minus prepaid expenses. Then you have done a question with me to learn how to calculate current ratio. Then we have done for the quick ratio also, where we discussed about the leverages. So leverage ratio के अंदर we discussed first leverage ratio, that is debt to equity, EBITDA. The formula is debt divided by EBITDA. How to calculate EBITDA? You know the formula. You can just do it the way the information is given to you. Then come your second, that is your debt to capital, that is total debt divided by total capital, and the total capital comprise of your total debt and total equity. Then come your debt to equity, that is total debt divided by total equity. Then the fourth ratio which we studied in the leverage category is your debt to asset, that is total debt divided by your total asset. We did a good question, a big question in which we calculate all the four ratios, and then we even did the interpretation of these ratios, right? In next video lecture we will be covering the other three remaining ratios, and we will complete the entire ratio analysis in the next video, right? So thank you everyone for joining this video lecture. I do hope you have understood how to calculate and what do we mean by the liquid ratios and your leverage ratios. And thank you, have a happy learning.